Hi friends, UAE finally come out corporate tax. If you are in corporate entity in United Arab Emirates, your income going to be taxed at 9% beyond 3,75,008. So at present UAE is low tax jurisdiction, nothing is taxed in UAE, but with effect from financial year began on and after 1st June 23, your business profit will levy a corporate tax at 9%. So this announcement is made on 31st January 22 by the Ministry of Finance UAE. So they have invited public comments in respect of tax structure in UAE. So let's understand how this will work. So suppose your financial year is ended on 30th June. So first tax period is 1st July 23 to 30th June 24. Basically in UAE, Georgian calendar year is followed from July to June. So this will be your first tax period. So 9 months from the end of the financial year, you have to file your tax return and pay taxes. There is no requirement for payment of advance tax, etc. So same way, 31st December your close, your 1st January 24 will be the cut-off date for first tax period. Same way, your 31st March is financial year ended, so April 24 will begin till March 25. So this will be the corporate tax they will levy. So what is the intention for UAE government and why it is levied? So let us understand. So recently there is Pillar 2. OECD has come out with the Pillar 2, PAPS 2.0. They going to implement global rule. They have either go for option Pillar 1, Pillar 2. Under the Pillar 2, they are want to levy global minimum effective tax rate. So they have suggested 15% ETR should be there. So UAE has chosen 9% tax rate in respect of business income in UAE. So who will be liable to tax? Only UAE incorporate entities such as LLC or company. Natural person will be outside from the scope. So if you are doing job in UAE, there will be nothing liable to tax in. So UAE corporate tax will apply to UAE company and other person incorporated in the UAE, as well as foreign company having presence as P in UAE. So natural resources, oil and gas are also outside from the purview of UAE CT. So as you know, Gulf countries, particularly UAE, is resources of natural resources is there. So they have levy emirate label tax. So they also given such benefit to the natural resources company also. So they don't want to tax anything. Investment fund rate, they can also get exemption. Free zone, at present there are free zone in the UAE. They also continue with 0% corporate tax rate in respect of income earned from such transaction in the free zone. But in respect of mainland, they have presence in mainland also. So in that respect of business profit, they have to pay 9% corporate tax. So who will be liable to tax? A legal person incorporated UAE. A legal person that is not incorporated in UAE, that is foreign company, but has P presence in UAE. A natural person who is engaged in the business of UAE. So basically, if you are incorporated entity in UAE, LLC company, you have to pay corporate tax. If you are not incorporated in UAE, in other countries like India or somewhere other country, but you have a P presence in UAE, in that scenario your source income in UAE also liable to tax. So basically they have given exemption to government owned entity, natural resources businesses, those are engaged in the extraction and exploitation of natural resources, that is outside from the purview of corporate tax. Charity, another public organization, public regulated private social security, and also investment fund, REIT, they can enjoy benefit even though after implementation of UAE corporate tax. So basically this is the flow chart. You can understand easily who are person, those are hit by UAE corporate tax, and those are person will be outside from the purview of corporate tax. So if suppose your answer is yes, this person will liable to UAE corporate tax. So basis of taxation, UAE residence person will be taxable in the UAE in respect of your entire global income. A legal person that is incorporated in the UAE will automatically considered as resident. A foreign company may be treated as resident if it is engaged, effectively managed or controlled in the UAE. Non-resident will be subject to UAE CT on taxable income from their P in UAE, income which is sourced in UAE. So now let us understand what is the P. Business income liable to tax in UAE. Same way they follow source based taxation as well as residence based taxation. So if you are residence in UAE, definitely your income is liable to tax, even though your entity is foreign company not incorporated in UAE but has a P presence as fixed place business presence in UAE or dependent agency P is there, then your income is liable to tax. So the concept of P is an important principle of the international tax law used in CT regime across the world. The main purpose of the P concept is to determine if and when the company has established sufficient presence in the foreign country to warrant the direct taxation of the business profit of the country in that country. Generally, a country only has the right to tax of business profit of the foreign company if it is only in case of P presence. So fixed place P is that a foreign company will have a P in UAE if it has fixed place in the UAE through which business of the foreign company is wholly or partly carried on for more than 6 months. Although they have given exemption to the preparatory or auxiliary service in nature, they will not consider P. Even though if you are maintaining some kind of space for the purpose of lying stock in trade or some display of goods that is make available to the another person in another country, that is also outside from the purview of fixed place P. So dependent agent test may be met where business traveler or UAE based person act on behalf of foreign company, act on behalf of Indian company in the UAE and habitually exercise or authority to conclude a contract in the name of foreign company. Suppose I appointed Mr. Abdullah in UAE in respect of my company, my foreign company, for the purpose of trade in UAE. They are negotiate the contract and they decide whatever the price they decide, they have a final authority, then it may be case of agency. This includes situation where person negotiate or conclude the contract in UAE on behalf of my Indian company. without material intervention from the my side. So this will be case of dependent agent B. So capital gain in the line of many other country, the leading international financial center, UAE corporate shareholder will generally be exempt from the corporate tax on dividend received and capital gain earned from the sale of shares. Same way, IFSC in India not liable to capital gain tax, they treated as outside from the scope of Indian taxation. Same way, whatever the capital gain arise from the sale of shares, earning of dividend income, passive income outside the purview of UAE corporate tax. Another thing, dividend paid by foreign company to the UAE resident and capital gain on the sale of share in both UAE and foreign company will also be exempt from the UAE corporate tax. But participation exemption must be followed. They have to maintain at least 5% ownership. Another thing, important thing, you have to compute your business taxable income. You have to prepare your profit and loss account. But there is limitation on expense. Interest capping rule is there. The same thing OECD has implemented through the Debt Action Plan 4. They have given 30% EBITDA limit. So suppose your debt in your balance sheet is in excessive form, you are claiming more interest expenditure in your P&L account, they will restrict you 30% of EBITDA. They don't allow more than that. So same way, non-deductible expenses there. Suppose you are making payment to free zone person, that is taxed at 0% on receipt of income, that will be also not allowed to you. Suppose you are running your business in mainland of UAE, you are making some related party transaction expenditure to free zone person. So whatever expense you are doing in respect of related party to free zone, that will be not allowed to you. Another thing important is 50% expenditure is allowed, not more than that. So businesses will be allowed to deduct up to 50% of expenditure incurred on entertainment, shareholder, supplier, other business partner, to acknowledge that these type of expense often also have non-business element or personal element. They are thinking you are incurring for your personal purposes, so they don't want to allow more than 50%. So losses, so they can allow losses against the offset against your taxable profit, but there is capping of 75%. Suppose brought forward losses, you can carry forward indefinite period, but there is condition, your shareholding should not change more than 50%. If your shareholding remain at least 50%, then losses can be carried forward to indefinitely period, but there is capping of 75%. Whatever your taxable profit, maximum 75% of that can be offset against the losses. So rest amount 25% is liable to tax. There is another concept of tax group. A UAE resident group of company can elect to form tax group and be treated as a single taxable person if the parent company hold at least 95%. Suppose you are holding company H Limited of various subsidiary company, you can elect I will be the single taxable person. So you can prepare your consolidated financial statement, and on that basis you can eliminate it intergroup transaction. After that, whatever your consolidated profit, you can enjoy, you can file with federal tax authority. I will be the single person, rest my subsidy will not liable to pay any taxes, file any return. I will be the single taxable person. The condition is that at least you must have 95% shareholding. Another case is that transfer of losses. Suppose you are not met 95% of criteria of holding, but you are holding 75% more than that. You can transfer losses from one subsidiary to another profitable subsidiary. Same way to holding company, you can transfer losses. So this is, in that scenario, 75% holding is criteria can be met. So transfer pricing regulation. The UAE corporate tax regime will have to follow transfer pricing rules to ensure that price of the transaction is not infused by the relationship between the related party involved. So they have to follow arm's length principle. In order to achieve this outcome, UAE will have to apply internationally recognized arm's length principle to transaction arrangement between the related party. A business will also need to maintain master file, local file, maybe CBCR. This is through the outcome of OECD BEPS Action Plan 30. So where the arm length transaction value of the related party transaction exceed the certain threshold that may be defined. So tax group is there, transfer pricing is there, tax credit. Obviously you are residents of UAE, might be some another country you have a PE presence. So on the basis of PE, your source be tax in other country. So in respect of source income in another jurisdiction, you may be some withholding tax is deducted there. So UAE government will allow to the resident of UAE foreign tax credit. So UAE resident company will be subject to UAE corporate tax on their worldwide income, which include foreign source income that may be subject to tax of similar nature of corporate tax by the another country. So to avoid double taxation, the UAE CT regime will allow a credit for the tax paid in the foreign jurisdiction against the UAE CT liability on the foreign source income that not be otherwise exempted. So this is known as foreign tax credit. So we need to compute foreign tax credit that may be lower of whatever the tax is paid in India in respect of Indian P source income in India, and whatever tax applicable in UAE corporate tax in respect of foreign source income, Indian source income. So lower of them, obviously UAE corporate tax will be allow you foreign tax credit. So no unutilized foreign tax credit can be carry forward or can be refunded. So friends, in summarized way, I can give you one important thing. This UAE corporate tax is applied from financial year starting on after 1st June 23. Your profit, business profit, is taxed at 9% beyond 3,75,000. Suppose you are earning 3,70,000 AED for a particular financial year, so you are not liable to any corporate tax. Even though there are some exemption in respect of natural sources, free trade zone can continue claim benefit, or investment fund REIT, but they have to apply for Federal Taxation Authority. Suppose you have a branch in mainland, and in respect of free trade zone head office, you are continue to claim 0% corporate tax, but in respect of mainland branch you have to pay corporate tax at 9%, even though in respect of free zone branch in mainland, not in respect of free zone, they can continue to claim 0% corporate tax. So who will be liable to tax? Incorporated entity, unincorporated entity in UAE, foreign company but have a P in UAE. So taxation is their concept, fixed place P concept, dependent agent P need to be tested, capital gain continue to be no tax, expense deduction limit is there, losses can be carried forward up to maximum 75%, tax group single person, and transfer pricing documentation need to be maintained, and last is tax credit. So this will be hit your financial year 1st July 23 to 30 June 24. You have to file your tax return by 31st March 25. So 9% is levy. So hope so friend you like this video and this is relevant for you. If it is relevant for you, so like, share with your another group entity. Thank you.